Right on. Welcome
Thank
to
you.
The Upside with Eli. That's the name of our podcast.
Oh,
if you
The
weren't aware of
Upside.
it. Yeah.
Okay. No, I wasn't aware.
Yeah,
I like it.
Thanks. We're joined today with Amal Assad, CPA extraordinaire. You're back in the office. You actually used to be in this office at one point.
Where I started.
This is, I wouldn't say
I
where you
mean,
start. Where you started and went fully independent. So that's
Yeah.
exciting.
Yeah,
We're
thanks
glad
for
to have you
having me.
back in the office.
Thank you.
Yeah. Did you survive tax season this year?
I did. I'm still recovering.
Still
actually.
recovering? Okay.
Yeah.
We
It's
had
been almost 2 months.
We're recording this on June 17th. So
Uh-huh.
June 15th, the self-employed filing deadline is done.
Right.
Did you have a lot of self-employed returns? Or
I had a few, but I don't leave things till the last minute.
but your clients
so
do.
those were done. No, they're not allowed to. So those were all done probably 5 to 7 days ago. Everything was done. Yeah.
Nice.
Yeah.
Right on.
So
Good for you, because a lot of the other accountants that we've got interactions with are just pulling their hair out still.
Oh,
So
really?
that's great that you're on top
yeah.
of things.
No, it's done. We're ahead of it.
Nice.
Yeah.
Right on.
That's who I like to work with.
There you go. So today, we want to chat about all things tax, a little bit industry stuff, a little bit of advice stuff, and thanks for joining us.
Yeah,
So,
thank you.
question number one: how the heck did you end up as a CPA?
Yeah, that's a good question. It was by accident.
Okay.
So I did start doing some bookkeeping. When I was in high school, meddled a little bit in bookkeeping.
As most people do, in high school, classic. Yeah, bookkeeping.
Well, I was really good at math, and it was something I enjoyed. And I started young doing my own tax returns because I had a part-time job.
Okay.
So I would do my own tax returns. And then when I did my own, I realized, but who are my parents using? Like, who's doing their tax returns? So I started telling them, hey, I can help you guys with your tax returns. And that's back when it was, you pick up the package from the post office.
Nice.
And you fill out all the schedules manually and you send it off. So I started doing it for family as well.
And how old you? That was high school, you said?
I was 15.
15? Okay, yeah.
15, 16, so I started at that age. And then a lady that I worked with, she was a great mentor for university students, high school students. She had hired me. I was working at a registry at the time, and I was having some trouble deciding what to do. And so she actually just said, okay, well, what are you good at? And I said, well, I'm good at accounting, bookkeeping class, and math. And I've been doing my tax returns. And so she opened up the yellow pages, and we chose, there were 3 bodies at the time, the CPA, or I think it was CA
Okay.
at the time, CGA, and CMA. So she's like, here, call one. So I said, okay. I called one, and I figured out what I needed to get done, and I enrolled in the program, and there we go.
Crazy.
Went from there, yeah.
And your kids are older than 15, some of them. Are they? Do you have them filling out manual tax returns to learn the family trade?
No, I don't. No, they do ask questions, so I do try to teach them.
Oh, really?
They learn to live on a budget.
Cool.
So particularly one, he's great at stretching his allowance over the month. So no, they're not doing manual. Who does manual tax returns anyways? You can't get the forms anymore.
Yeah, I don't know. You see those stats from CPA Can or whatever, the number of, or maybe it's from CRA actually. It says the number of ones that are electronically filed versus not, and I don't even know how people do that on paper anymore.
Some people still, because you could do simplified ones on paper.
Okay. Or
some of them you have to mail in.
Yeah.
But no, kids are not. They need a job first.
There you go. Right on.
So
you looked that up. You went with one. You got your education done, and then
kind of did it concurrently while I was working.
Okay.
Yeah, so I did both, and then before I was done, I got a job in public practice, and I started working there, and I worked there for a very long time. Just kind of worked my way through that organization, and until there was nowhere else to go.
Cool. And then you went off on your own.
Yeah, I went on my own, started my own thing, and it was one of the best decisions that I have made.
Cool.
I would say. Yeah.
That's great to hear.
Yeah, I love working with small business owners. I love supporting them in that process and really learning the story behind what they do versus just the numbers. So that's a passion of mine.
Yeah, and I feel like that's kind of the clientele that's also kind of attracted to you as well, right? People who want a little bit more in-depth, one-on-one, kind of a combination of planning plus compliance work plus just
And
someone
that
to chit chat
value,
with about things
yeah,
too.
value the relationship versus just file my tax return. There's no, yeah, there's no value in that, right?
Yeah,
So,
totally.
yeah,
Cool.
yep.
And so what types of clients do you work with now?
I don't have a very specific niche. I do have a lot of experience working with health professionals.
Okay.
In my previous role, I did a lot of that. So I do have a fair share of health professionals as part of my client base right now.
Okay.
A lot of
How do you define health professional?
dentists, doctors, chiropractors.
And a lot of like obviously self-employed and like professional corporations we're talking as well, or
I would say incorporated professionals.
yeah,
Right. Yeah, like PCs. Yep.
cool.
Yeah, so I work with a lot of them. We have some interior designers, a lot of creative types, little bit of both.
Yeah,
Yeah,
cool.
which gives exposure, right? I love to learn about the different industries and how, I'm a curious person. So
Yeah.
it's nice to see how the different businesses work and yeah,
Right on.
yeah.
And you do a kind of a combination for clients. So you do a lot of tax planning, but then you also do kind of compliance work. How do you kind of structure? And obviously every relationship might be a little bit different, but what are some examples of different structures that you have in place for different clients?
Service structures?
Yeah.
Yeah. So we can do everything from bookkeeping up to your tax planning, right? And it really depends on client needs. So we'll sit and meet. Some clients, they have a little bit more of a detailed needs, not detailed, but expanded. So if you have a $5 million business, you probably need an internal bookkeeper, right? But
Sure.
if you have, $100,000, $200,000 business, 500, whatever the case, you probably want to outsource that instead of hiring someone. So just depending on their level of need when it comes to bookkeeping. So we assess that at the beginning, see how we can support with that. Some clients that already have an external bookkeeper and that's going well, they just need someone to do compliance. So we meet at the beginning, at the onset, the onboarding process, assess really what they need, what services we can provide, if we'd be a good fit for what they need, and then move from there. So we could do anything from bookkeeping. As I said, we do the compliance work. So by compliance, the corporate tax return, GST, T4s, T5s, those kind of things. And then any shareholder remuneration and planning. So we're looking at what kind of strategies can we employ to pay those business owners tax efficiently, right? And then we extend beyond that into what tax planning do we need to do. So for example, if you have a business that you're planning to sell in next 3 to 5 years, what do we need to do in advance to make sure that you plan for that tax efficiently, right?
Totally.
So you don't want to be doing that when your business is for sale and you're at that time. So these are things you need to plan for in advance.
Totally. And if somebody is going to be selling their business, how far in advance should somebody like that be starting to restructure their affairs or at least look at things in anticipation of a sale?
3 years.
3 years.
Yeah, no less than 3.
Yeah.
So that period from 3 to 2 years, right? That is key. I would say.
And why is that so crucial?
That's crucial because you want to ensure that you qualify for the lifetime capital gains exemption, and some of those rules, the qualifying rules, they need to be addressed 24 months in advance.
Sure.
So that's why we look at it
Cool.
at no less than 3 years.
Yeah. Just
Right.
make sure you're not missing
Yeah.
out on potential opportunities because we'll run into that a lot with clients who are like, because we deal with a liquidity event, so it's, hey, I just sold my business, now what? Or I'm going to be
Right.
selling it next month. What do
Yeah.
I do with all this money? It's like, well, we shouldn't have had this conversation
Yes.
quite a bit in advance because there's lots of tax planning opportunities there. And then also it's, being able to structure things and do things gradually over time because it might affect how you sell the business too, right? In terms of like the
absolutely.
type of structure that you choose in terms of the sale as well.
That's right. Yeah, I couldn't agree more. And I think if you do your research in advance, you can't go wrong. But if you've missed a timeline, then you can't turn back time, right? So just doing your research in advance, talking to the right people, and these are actually conversations that should be had with your account every year, anyways.
Sure.
So these are things that we talk about on a year-to-year basis, right? What are your plans going forward? What are your goals? what are you planning to do with this business? Because that really guides any type of tax work that we're going to do. So annually, if you should be meeting with your accountant at least annually, and we're having that conversation annually of what kind of planning do we need to do for you, and just understanding what are this client's goals and where are they going with this business.
Yeah, absolutely. And we find a lot of, accountants. And the nice thing is that you kind of went into running your own business, later in your career, you already had a ton of experience. And so you've been able to be a little bit more choosy about clients. And you've kind of said right from day one that that's the type of work that you're going to be able to do and kind of commit to for people. So I know from our experience, when we've sent you kind of clients, that's what people really appreciate is the actual like planning and forward looking stuff rather than just, okay, what did you do last year? Let's file your taxes. And I think that's what a lot of, especially business owners, that's what they need, because there's so many different kind of nuanced rules, and that's something that you tend to focus on heavily because it's really important.
Right. And if you remember, so I did my CFP designation at the beginning, right, when I started all of this.
Yeah.
And that was really to bridge that gap, because what I felt was, yes, client comes to us, they it's at the end of the year that they're coming, and there's not a lot of planning that you can, there's a little bit that you can do, but
Sure.
I found that it was just filing their taxes and providing, here are your numbers, pay these installments. And it wasn't forward looking. It was, reactive instead of proactive.
Yeah.
And so that was one of the things that I wanted to address is, okay, how can I better serve clients? And so that was one of the reasons that I decided to do that, because it helped me understand both sides of the coin. And I feel like, when I talk to you, when I talk to Nathan, it's a lot easier to speak when we speak the same language.
Yep.
Right. And I'm looking at both sides of the coin. So that was one of the reasons I did that too, to provide a more wholesome service.
And then the feedback on that is great because clients are really happy.
Yeah.
And on the flip side, if for people listening to this, if it's a new business and things like that, the one thing that you've been really good for a lot of people on is when you're brand new and you have no idea about setting up a GST number, setting up a corporation, like what is even involved in bookkeeping, how to file taxes, like how to manage all that kind of stuff. And because of the way that you've structured your business, you have the flexibility, the ability to actually sit down with people and teach them about these things and walk them through that stuff. Because I think that's so crucial. Is so many people, when they first set up a business, is that there's so many moving pieces and they're just trying to focus on making money, right? Let alone worrying about all these kind of different structures. So it's nice to have somebody kind of guide them through, that process so they don't set stuff up and then realize, a few years later, like, oh, shoot, I probably shouldn't have done that.
Yeah.
And it might not be too late to make those changes, but there might be costs, and errors that were set up along the way rather than just going to a professional right off the bat and just doing it correctly.
Yeah, being proactive. So I love a clean slate.
You don't like cleaning up other people's messes?
I'm not saying it's a mess, but I'm saying like when someone comes to me at the beginning and I have the opportunity to educate them, I love that, because just having them feel empowered and educated about these minor things that to me I might deal with every day, but to them it's very new, right?
Totally.
As we can't be perfect at everything, right? So I love having that opportunity to educate them at the beginning and really just make them feel comfortable and set that, be approachable, set that intention in the relationship is like, if you have any questions, if you need anything, let me know. And then what I see over time as the questions subside, they get a lot more comfortable with what they're doing. They understand the process. We're very process driven, and it works out beautifully. So yeah, I appreciate that. And on that note, I would say, talk to someone before you incorporate.
Sure.
Right. What I often see is some clients that, they want to start a business, they incorporate thinking that's the first step, but that might be the last step in the process.
Sure, and whether you should even incorporate, whether there's value in that or not at this stage, because we'll run into that where people are like, I just went down to the registry and they did it. They had a guy there who could do it for me. It's like,
also, like, you could go to Dollarama for something, or you could go to like something more high end. But, you get what you pay for, really, when it comes to that. But that's not the point. The point is, I think, assessing if you need a corporation first. Because I'll have clients that are making, say, under 100K, and they have an incorporation, and they're taking everything out of the incorporation. So really, you're just setting yourself up with a lot of administrative functions and costs that you probably don't need anyways. So yeah, I encourage people to have that conversation before they go ahead and make the decision to
Sure.
incorporate.
What would you say are some of the factors involved in deciding whether you should incorporate or not?
Yeah, so income level is one of them,
Okay.
whether you need those funds or not. So if you have a corporation and you need to take everything out of there to live off of, you probably don't need an incorporation, right? So those are things from a tax standpoint.
From a tax perspective.
Yes.
Yeah.
Other things, of course, that you want to think about are liability, right? Some company or some people may incorporate for liability protection. Also, maybe if you're a professional like a doctor or dentist and you need to incorporate, that's another story. Usually they have excess cash anyway, so
Sure, fair enough.
It lives in the corp. But those are some things I'd be looking at
Yeah.
in the beginning.
Yeah, makes
So
sense.
liability, tax issues, income level.
Yeah.
Yeah.
Yeah, and it's not like a one size specific, because sometimes we'll get that question, right? Is like, at what point do I incorporate? It's like, well, there isn't like a universal like set standard. So it's, I think that's something people can talk to you about too, and just say, okay, based on my situation, does it make sense? Does it not make sense? What are the costs? What are the benefits? Right? And you can kind of work through that rather than just like a blanket statement.
Yeah, and really, you can start with as a sole proprietor, right, and then move to an incorporation later. But you might want to give it a year, for example, try your business out that way. There are other things that you need to take into consideration too, like some of the bigger agencies, for example, that they I guess place contractors, subcontractors.
Sure.
Some of them require you to incorporate as well.
Gotcha.
So that's something I see often too. I think there are ways around that, but that's something I see. They push incorporation on to professionals that are doing like consulting work, for example. It's big in oil and gas.
Yeah, 100%. Yeah, makes sense. Right on. What would you say are the most common questions you're getting these days from clients?
Okay, number one question of all time.
Yeah.
Can I write off my vehicle?
Okay. And?
Well, the answer that people never want to hear is it depends.
Sure.
It really depends on what you're using it for. So can you take your personal vehicle that you drive your kids to soccer practice and you pick up your groceries and you drive day to day to work, slap a logo on it and consider it a business vehicle? The answer is no. The logo is tax deductible.
the actual cost of the decal.
Exactly.
Okay.
But the vehicle is not.
Yeah.
So this is a conversation I like to have with clients is, one, help me understand what your risk level is.
Sure.
If you are a person that wants to take zero risk, you want to be above board on everything, and you want to tax deduct your vehicle, I wouldn't advise you to do it.
Yeah.
But let's say you have, you're a realtor, for example, and you use your vehicle a lot for business. You're driving more than 90% of the time is CRA's criteria. Maybe you have another vehicle for personal use. Maybe you don't. But then it's more practical and realistic to be able to record that vehicle in your corporation.
Sure.
And have your corporation pay the expenses of it. Now, something CRA does look at is there any personal benefit that you're deriving, right? Technically, what we are required to do is calculate that personal benefit, and you are supposed to pay personal tax on it as well. So,
and that's per kilometer?
There are formulas that we follow.
Okay.
So it depends on whether the vehicle is leased or the cost of the vehicle and the percentage used for personal use.
Gotcha.
If I'm honest, I don't see many people do it. But it is, those are the rules.
Yeah, and that's when the vehicle is owned by the corporation, you're using it for personal, and then what about if you own the vehicle personally and you're using it for business use?
Right, if you own the vehicle personally. So the interesting thing is when you buy a vehicle through the corporation or lease it, you're capped at how much you can tax deduct each year. And then when you fully depreciate that vehicle, that's done. You don't get any more claims for that, except gas, for example, insurance, anything that you need to pay through the vehicle. But on the flip side, let's say that you are using your personal vehicle for business. CRA sets out rates that what you can do is you can calculate the number of kilometers that you use for business, and you can calculate the kilometer reimbursement and reimburse yourself. Since that's a reimbursement, it's not an allowance, it's based on actual kilometers driven. There's no limit on that, on what you can tax deduct through your corp.
Sure.
and it's not taxable to you on the personal side either, because you're just getting reimbursed for, what you used the vehicle for business purposes.
Sure.
And then if CRA reviews that, so in that case, for example, if they want to review your vehicle expenses, you need an auto log.
Yeah, and I think I don't know if it was 2 or 3 years ago, CRA went after a ton. Like, it seems like every few years they have these ones where they just like audit like crazy. Like I know we got audited for our vehicle logs. Like we had a lot of clients that got audited.
Yeah, they were pursuing that during that time. So vehicles was a big one, and I can't think of any that were reassessed through us. So, we can support clients through that process as well.
Totally.
So that went off well, and then they kind of died down a little bit during COVID because they were reviewing subsidies and that they still are reviewing some of the subsidies as well.
Oh, really?
Just had a client. Yeah, we closed her case this week. It was a CERB case.
Okay.
And that had been in process for maybe 2 years.
Wow.
Yeah, it was being reviewed for 2 years. So, but we just closed it. It was successful, so that's good. So right now they're looking at foreign tax credits for both business and personal is what I'm seeing.
Yeah, okay.
Foreign tax credits, yeah. And medical expenses is always a big one.
Gotcha.
Yeah.
That was good. That was going to be my next question is, like what are you running into right now in terms of tax filing? What are they going after? And have you had many, reassessments? Have you had many audits?
Yeah, I haven't had many corporate audits recently. The ones that we've had this year are advertising expenses.
Okay.
Is what they've been looking for, and I can share an interesting case with that one too. And then on the personal side, they're looking at foreign tax and medical is what I've been seeing heavily. Yeah.
What's the advertising case?
So the advertising case is this is something I would like to share with people and have more people aware of.
Sure.
Is that not all accountants are CPAs. So when you work with a CPA, we are accountable to our association. There are certain professional development that we have to do year to year. Our firm gets reviewed. So CPA comes in, chooses some files at random that they would like to review. We hand over all of our working papers for them to go through and assess. And, there's accountability in that process. Whereas some quote unquote accountants or tax preparers, they are not registered with anyone. They're practicing as an accountant, but and maybe they have some experience with some things, but to support with compliance and things like that, it may not be the best option. So I have had several clients come over to me from accountants that they think are CPAs, but they are not CPAs. So it's been an interesting learning process and helping them learn and become educated on what are the differences, what can you expect from a CPA. So the advertising case is we onboarded this client probably a couple of years ago. Okay. And when CRA reviews anything, they can go back up to 3 years from your assessment date, right? So what we often see is they come up close to that reassessment date and they will request information from you. So, let's say your return was filed in June and assessed in July. They have 3 years from that assessment date to request supporting documents.
Gotcha.
And they often do it right before that timeline expires, right? So she had a reassessment, or not a reassessment, a request for a processing review. Okay. And that was for advertising expenses. And her accountant would refuse to release any of the documents. So we didn't have, her accounting records from then because it ended
and there's no professional body that you can go back to and report them to for that.
Yeah. So we had the number of her total accounting expenses, but we had to figure out what was included in that during that year. So we really had to recreate some of her records based on her banking statements, any invoices she can find, and go through with that. So in the end, we were able to support most of it.
Sure.
But it's gives you it's a good reminder and a good lesson on when you're going through this process every year, where are you keeping your copies of your records? Mm-hmm. You need to get those and you need to keep them because ultimately you're responsible and you don't know what happens down the line. So in this case, their relationship ended in a bad way.
Yeah.
And she wasn't able to get copies of any of her documents from that accountant. So that takes a
Brutal.
lot of time.
And if that individual was a CPA, there would be the recourse where you could go to
Yes.
potentially to the CPA
Yeah.
society and
Yes.
not force them, but effectively, right? They're
Yeah.
going to have to comply in order to maintain their professional
Yes.
designations and everything like that.
Yeah,
Right?
absolutely. And on that point as well, CPAs, I don't know if all of them carry it, but we carry audit insurance.
Okay.
So for a small fee, you subscribe to
Sure.
insurance.
Yeah.
We don't make anything off the premiums, but what it does is in a case like that where she didn't have her records, the insurance company would pay us to recreate all of that and do that from start to finish.
Gotcha.
Yeah.
Yeah, that would be handy.
Helpful. Yes. Yes.
Right
Yeah.
on. Okay. Yeah. So vehicle. Yeah. What other planning, or I guess what other common questions do you get from clients these days?
But the vehicle is probably one of the most common.
Yeah.
Salary or dividends is
Okay.
another question that I get a lot.
Yeah.
And that's a question I like to answer. So I like to talk to the advisor too to see what is your long-term plan. So it
Yeah.
really, to me, it's not black or white, and it's not what is the most tax efficient. Of course, that plays a part in it, but also what are your goals? For example, you may be self-employed and paying yourself a salary through a corporation. And let's say you have young children and you have daycare costs, for
Yep.
example. Those are all tax deductible childcare costs. So really, it's looking at what point of life are you in? What are your long-term goals? Do you want to use RSPs?
So that would be an example where you want to have salary so that you have the deductible
Yes,
expense.
Yes, yes. So asking all of these questions
Yep.
versus some people, and also it comes down to business cash flow as well, right?
Sure, yeah.
So some businesses have very consistent cash flow. They can pay a salary.
Set up a payroll structure.
Exactly. Yeah. Where you have a more inconsistent cash flow, it may be wiser to take dividends. And let's say you don't need a salary. So if you don't have any financing needs coming up, for example, and dividends work for your stage of life and what your goals are, then we would move to dividends. So the one thing I like to take into consideration or share with clients is, how are you with cash flow and saving? Because,
Yep.
right? Because when you have a salary, your tax is deducted at source and your company is paying that tax to CRA at that time,
Yep.
right? Whereas when you have dividends, you need to be responsible enough to set some money aside. You take out, let's say, 10 grand and you're putting 20% aside. And we work through those numbers. I'm just giving this example just
Sure.
as an example. So we work through those numbers and give clients an idea of, okay, this is what you should set aside so that come April, you have money.
Yeah.
If you don't have money, you end up paying, you take more out of your corp and your dividend grows and then you owe more tax.
And you see that
it's
so
a cycle.
frequently with a lot of like newly self-employed individuals who've never done that before, especially, and I shouldn't even stereotype one industry because it's just everybody. Unless you've been through it before to realize that, no, not everything you make you get to keep because they're just not
That's
used to
right.
have. They're just so used to just having it deducted off the
Yes.
source and be able to spend whatever's left. So,
Yeah.
that can
Yeah.
certainly be a shocker for some people. And then what they do is they spend the entire next year, trying to pay off the previous year's tax
Right.
bill, but they're still not putting aside the taxes for that year. So they're always kind of working
That's
1
right.
year behind.
Yeah, and now you have in tax installments. Year two, you usually have tax installments you have to consider.
Yeah.
So that's why I like a clean slate.
Sure.
Because we chat about that up front. And so we've created a package for new clients, for example, newly incorporated, where we sit and we have these conversations at the onset
Okay.
and walk them through what to expect in this process, what's going to happen at the end of year one, and just give them that background knowledge. So when the time comes, it's not total shock.
Yeah.
Right. Not
Yeah.
to say it's always total shock, but it's good
It
to know.
often
in
is.
advance. Yes. If you
'Cause-
don't.
and it's not there's anything wrong with the individual that did it. It's just there's just so much you're trying to figure out and learn when you're a brand new business owner, which is why so many people get caught up in that.
Absolutely.
Yeah.
Yeah. So it's good to have the right support.
Yeah, makes
Yeah.
sense.
Yeah.
Cool. Alrighty, we got some rapid fire questions to
Rapid fire, okay.
to finish off the podcast here that people have
Okay.
submitted questions around that.
Okay.
So I'm just gonna jump into it if you're good.
Okay. Yeah.
Okay.
Let's hear it.
Question number one. One of the most common questions that we get are RSPs a scam?
Okay. Okay. are RSPs a scam? No, they're not a scam, obviously. So interesting. I was at a function, family function, on the weekend, and this conversation came up: is, well, when you put money in an RSP, you pay tax, and when you take money out, you pay tax. No, they're not a scam. So what happens, to explain that mechanism, is when you put money in an RSP, you get a tax deduction. So let's say you make $100,000 and you put 20% or 20,000 in your RSP, that is deducted from your income. So you're not paying tax on that $20,000, right?
Yep.
Now you put that money inside of your RSP and it grows for the next 15 or 20 years. What you've earned in there, you haven't paid tax, and there's also the time value of money to consider. It's been growing for 20 years.
Yeah, you got more compounding
exactly.
on not having to pay the tax.
Yes. Yeah, and let's say you're in a bracket where, $200,000 a year, or you're in a very high tax bracket. Now, when you take it out, theoretically in retirement, you would be in a lower tax bracket most often, right? So you're taking it out, you're paying now a lower tax rate on that money, and you've been saving this whole time. So it's not a scam. What I tell clients is it's not a tax. It is a tax deduction, but it's more of a deferral.
Totally.
So you're pushing tax, which is what we do with corporations too.
Yep.
Very similar. It's a deferral.
And it's funny you make that analogy, because so many people are like, they love the corporate tax deferral mechanism, but then for some reason they think RSPs are scam, when they're very, very similar type structures.
Yeah. I love RSPs. I use them.
Me too. That's why I pay myself a salary, so I get more RSP room.
So you get your
right?
RSP room. Yeah. And then there's different options, right? Like the spousal RSPs, for example, that would allow you to income split during retirement as well.
Yep.
So no, they're not a scam.
Not a scam.
Yeah.
Perfect. What the heck is alternative minimum tax?
Okay.
And why do people pay it?
Let's do a very simplified. It's that when the CRA isn't happy with how much tax is calculated, they want you to pay, a minimum amount. And so they have a second way of calculating taxes to make sure, you're not getting the better deal. So that's how I would describe it. And I did have a client who, he unfortunately had sold his business and hadn't spoken with someone in advance. There was no planning done. And this gentleman had sold it going into retirement. So he didn't, after that, he was planning not to work. And he paid quite a bit of alternative minimum tax, AMT, we call it.
Yeah.
And so usually there are ways to recover AMT with proper planning. So we would plan for, okay, are you staying on with your business? Let's give you some salary after, some dividends. Salary recovers it more quickly.
Yep.
So in his case, he was going into retirement, so he paid AMT, and there was no way to recover that. Yeah, unfortunately. So AMT is a higher rate of tax, as we know, but it is recoverable with the proper planning. And usually we see it in cases like that, where you have a big capital gain or have used your lifetime capital gains exemption.
I was going to say, those are probably the most common situations that we see: lifetime capital gains exemption, sale of a business.
Yeah.
Obviously, there could be others, but I would say in our experience, that's probably the most common.
Yeah. So again, important to get the planning done in advance.
And all the more reason to talk to somebody like you ahead of time instead of coming to you after the fact when it's too late.
Yeah.
Cool.
Yeah.
Question number 3, which jumps right into that: how does the lifetime capital gains exemption work?
How does it work? Right. So the lifetime capital gains exemption right now, it's at $1.25 million. And what it does is it shelters gains from a qualifying small business. So a qualifying small business, there are various criteria that need to be met in order to have your shares of your business qualify for the lifetime capital gains exemption. So it applies when you sell the shares of a business, not the assets, right? That's an important distinction. So when you're, again, starting to plan for a sale of a business, this is something that needs to be taken into consideration. What we often see is sellers want to sell shares.
Yeah.
Buyers want to buy assets.
Totally.
So it's kind of finding that, common ground. There are hybrid ways to do it as well.
Yeah.
So the lifetime capital gains exemption, it shelters up to $1.25 million of the sale price. And it basically makes that tax-free if you've planned for it in advance and you ensure that the shares of your business qualify. And you get that so that's lifetime capital gains exemption. You get it once in your lifetime.
Yep.
Yeah.
And if, for example, you used that amount when it was lower, before it was 1.25 million, you still have some, left over
Yes.
for future sales. And that was something that CRA actually had issues with this last year, is they were going back through and they were using the wrong numbers. So I know there's a number of assessments. I don't know if you've run into this in your practice, but I've heard from other accountants that they were assessing that incorrectly. So there's a lot of those that are kind of open-ended right now, I think.
Yeah, as is everything with CRA right now. So yeah, they had massive layoffs, and just as I shared with you, one of the reassessments that we did, or the COVID, it took 2 years.
Yeah.
So adjustments are taking quite a long time. Audits are taking a long time to receive feedback, and they are very backed up. So yeah.
So don't expect anything quickly.
Yeah, basically. Yeah.
Fair enough.
Yeah. But that's a bit about the lifetime capital gains exemption. And then another point on that is also in planning for that, when you're setting up your business and when you're structuring it at the beginning, is considering should you have any other of your family members as shareholders, right? So, considering adding a spouse or an adult child, depending on, each person's situation, obviously, but assessing if that would be worthwhile, because that would ultimately double your exemption in the future if you add, a spouse, for example.
Absolutely. What is the difference between a tax deduction and a tax credit? People always get confused on that one.
Right. So tax deductions are an actual deduction from your income. So let's say an RSP. So if you have $100,000 of income and you contribute $20,000 to an RSP, you get a deduction. So it's like you made less money, right? So now you're taxed on the $80,000. Whereas a tax credit, depending on whether it's refundable or non-refundable, so let's say a medical tax credit, right? Depending on what your medical expenses were for the year, those you get a credit against taxes payable, and that credit is calculated based on the lowest tax rate. So let's say, for computation's sake, you spend $4,000 on medical expenses. Assume that it's not all tax deductible, but assume that it is.
Sure.
And your lowest tax bracket is 15%, right? So that credit is calculated based on 15% times 4,000, so $600.
Yep.
And you get that applied against your tax that you already paid.
Right.
Okay?
So if you owe $10,000, now you owe $10,000 minus $600.
Exactly. So one is a deduction from your income, whereas one is a reduction of taxes payable, right?
Makes sense.
And some are refundable, some are not. Yeah.
And what does that mean, refundable versus not?
Refundable versus not. So, for example, the Canada Workers Benefit, that's a refundable. Is that a tax credit? I can't remember if that's a credit.
I'm not sure on that one.
I'm not sure on that one either. So, yeah, refundable credit is where CRA gives you money even if you haven't paid the taxes.
Sure.
Right?
Yeah.
Whereas non-refundable is you would get a credit up to the maximum amount of tax that you paid.
Yeah.
So you can't get money back if you
Can't get
haven't
money
paid
back.
tax. This is what it is. When you're getting a refund, it's usually your own money that you're getting back. They've kept for the year.
Yeah. And that's why it's nice. There's certain ones that you can carry forward to future years. So you don't necessarily want to use them all up this year because you're not going to get a benefit for it. So you might as well carry it forward to the next year, and that's planning that you'll do as well. To figure out which ones to use this year versus carry forward.
Yeah. So, a good example is the first home savings account.
Okay.
Right. So people are opening them, they're contributing money. Maybe they don't have a plan to purchase a home now, or maybe they're in a low tax bracket now. So what we would do is defer that to a future year when it makes more sense to use it and when it saves them more tax dollars.
Totally.
Yeah.
Yep. That's a good example.
Yeah.
Perfect. So that's all of our rapid fire questions.
It. That's all your rapid fire. I was expecting more.
You're expecting more?
Yeah.
Well, we'll have to have you back again then.
Okay.
But yeah, that's all we got time for today. But yeah, thanks so much for joining us. If you want to get in touch with Amal, I'll have her contact information posted, I guess below. I mean, it depends on where you watch this video or where you listen to it. But yeah, thanks so much for joining us.
Thanks for having me, Eli.
Hopefully we'll see you again soon.
Yeah, that was fun.
Okay, thanks.
Thanks.